Welcome back. As promised, let's now move to real estate. We did catch up with two companies today, Sobha as well as Godrej Properties, to find out how sustainable the demand pickup is and what they're seeing in their specific markets. Hear this out and then we'll take the conversation forward.
We believe we should be doing better this quarter than what we achieved in the last quarter. And our second half this year should be better than what we achieved in the same second half last year. Value-wise, definitely will be significantly better. On volume-wise also, we should be doing better than the last year. It is not that the prices have increased. On the one hand, the discounts have come down. What we used to offer, the discounts have come down. On the other hand, somewhere you see clear stability in the prices also.
There is a demand which is there on the sideline, and whenever there's a quality player bringing quality project, the customers are taking the projects and buying them. So overall, we are quite bullish. If our launches go as per our plan, of course, they're subject to approvals getting on time. We expect that we should, see some growth over the last year numbers. See, prices have been stagnant for quite some time, and I think it will remain so for a couple of more quarters. We haven't seen any reduction in pricing, but obviously the prices would not be going up at least for next few quarters.
Okay, so that's both companies sounding fairly optimistic. But Prakash, the thing is that one needs to match the price on the ticker also with future expectations, right? And the stocks have rallied. Godrej is barely, I think, 5-6% away from its 52-week high. So the question is, should one be buying now?
Well, if your horizon is slightly longer, at least the next 2-3 years, I think real estate as a cycle is just kind of getting its act together. And I can tell you anecdotally, the number of developers in some of the larger markets have actually come down. The mortality has been significant in the last 2-3 years, given the liquidity crunch last year, and of course the demand crack that we saw in the beginning of the lockdown. But what's working is people who have inventory, who have affordable price points and a good mix of geographies. Now, from that perspective, if you see a Godrej property, it's definitely top notch. We spoke about this 2 weeks back as well when it was sub 1,000. And now you look at the way financing costs have also kind of started accelerating the whole process. So stamp duty reduction in Bangalore probably benefits a Sobha as and when it happens. Godrej Properties starts looking at getting inventory turnover, which helps them actually get into newer projects on the asset light model that they follow. And the low cost of housing finance is one of the biggest catalysts also. So I think yes, you could still buy. I know it seems slightly over the top at times when you look at from where they've come back. But there's much more legs to this rally. If you, especially as I said, if you have a slightly longer term view on the portfolio stocks.
Okay, Prakash, before we let you go, has Indigo topped out? It's back to highs, and while you could argue that as of now there's no problems about the flights, there was this buzz, of course, last week on Delhi-Mumbai sector being in some trouble. But in general, would you say that perhaps the best could be out of the way now for the stock?
I think it's an air pocket that they've hit. This second wave and the timing of the crude strengthening has probably been the reason for this slide that we saw from its recent highs, Anuj. But given the overall secular structural change that we are seeing in this setup, and remember next year, as and when the vaccine starts showing its effect or things start easing out again on the expansion of the epidemic itself, there is going to be a huge revenge travel that will come through, and Indigo will probably have its supremacy in terms of market share and pricing back again. So I would believe any dip that you see, which could bring it closer to 1,450, 1,500 bucks, that probably will be a buying opportunity for the next all-time high, which is, I think, above 1,900. So I'm quite positive, and this will be the opportunity to buy into it. Let it slide and consolidate, and then you buy it before it takes off for the next move.
Okay, all right, Prakash. Thanks very much for joining in. Always appreciate you being with us on the show. Right now, let's move on to a promised special. And this is, of course, the segment that Anuj brings to us off the charts. And this time, he's looking at a stock which, hold your breath, has generated a return of 5,000 times in the last 1 decade. Check this out.
We have looked at some big 100 to 500 baggers in off the charts, and that made me wonder, can it be bettered? Well, just dug into some numbers and we arrived at a 5,000 bagger. Today in Off the Charts, we talk about PI Industries. The year was 2001. The PI industry stock was going through a crunching bear market and had fallen more than 70% from its peak. But the management was building a strong business model. And it's here that if you invested 1 lakh rupees, this is how it would have turned out. An initial investment of 6,675 shares at 15 rupees would be worth 50 crores today if you take into account the bonus and stock splits. Now let's take a look at the compounding machine that PI has become. And there's a reason that I'm looking at numbers of last 10 years, and I'll explain that. In the last 10 years, the company has compounded sales at 19% from 700 crores to 3,400 crores. EBITDA has compounded 22% from 120 crores to well over 750 crores, and profit has compounded 24% from nearly 60 crores to 450 crores. Now, as is the standard template, the re-rating ensures the market cap compounding of 47% from 1,000 crores to well over 34,000 crores. All this while paring down the debt to equity from 1.1 to nil in 2019. It's gone up to 0.2 only to finance a large acquisition of Isagro Asia. So what has been the unique story of PI Industries that needs to be told? Well, in childhood, we all learned of stories of making a solid foundation for tall buildings. The story of PI success is in the 10-year foundation of building a unique business model, a model where initial scale-up was low, but the rewards were exponential. The company spent a decade in winning the trust of innovators. For starters, it has two key businesses, agri-inputs and custom synthesis or CSM. 95% of the CSM business is generated from patented molecules where the company is not involved but is partnering the global innovator who is very careful about the local partner in every country. Now, once this trust is built, it makes the company a monopoly in a very high margin business. There have been some key inflection points for the company. In 2007, it started execution of the CSM model from its Panoli plant, which peaked out at revenues of almost 500 crores. And the company has the foresight to build another plant in Jambusar with revenue potential of 2,200 crores, and there was no looking back. In 2010, the company sold its polymer business, which was highly working capital intensive, and that helped the company pay its debt and focus squarely on agri and CSM business. That's been the unique story. Lastly, a word on the background. The company was started in 1946 by P.P. Singhal to manufacture edible oil with original name of Mewar Oil and General Mills. The name was changed to Pesticides India in 1960s and then shortened to PI Industries later. The Singhal family has never focused on stock market returns. That's one quality which comes across in various con calls. In fact, when I tried talking to the current MD Mayank Singhal, he was least interested in talking about his own stock. So I had to do all the extra hard work myself. But it's been a remarkable story. A lot of people believe that perhaps this company could make its way into the index. Whether that happens or not, we'll find out. But for now, enjoy the success story.
What an interesting story once again. And Anuj, as I think about a lot of the off the charts that you've done, it comes to mind that many a times the biggest compounders are companies run by people who are not obsessing over just the stock market value.
Yeah.
They're actually obsessing over their business. Yes. But anyway, I want to know more from you. What stood out for you in the PI story?
No, I think you hit the nail on the head. And sort of, a lot of people tell me that, what's the next PI? Of course, I hope, I knew. Or the reason, we try to point out some of these stories. For example, it would have been very easy to, look at, frustration with, what PI was doing in the early 2000s. But, if you're building a solid foundation and if you believe in your business and if you're making all the right steps, of course, you could still go wrong if the luck doesn't favor you and, the luck has to favor you. But then more often than not, you will end up with a good story. And, you would notice that in most of the multi-baggers, the basic tenets remain the same, which is the respect for equity, not getting into a bit of a debt trap, being focused in what you're doing, and doing it with integrity. I think these are some very important points. For example, when we did the off the charts on Shree Cement, I had given a hint about what kind of companies are doing similar stuff to what Shree was doing, and you saw some of these stocks after that moved 30-40%. So when you do these kind of stories and you identify stocks, for example, with a market cap of say 100 to 500 crores, and then you apply these parameters and see if these companies are ticking some of these boxes, and then perhaps you want to take a bit of a bet here, and then you have to sit on that for 10 to 20 years. Then you can't be looking at that 3 months later and saying that okay, it's only gone up 1% or 2%. A lot of the stocks go through cycles where they don't move for 10 years, and in 1 year they give you returns worth 10 or 12 years. So all of these are important lessons that you learn when you look at. And what's fascinating, you learn a lot of annual reports. You read annual reports of 5, 10, 15 years. There's a lot of stuff which comes out by reading annual reports.
Oh yes, absolutely, and that's a lesson to keep in mind if someone wants to be in the market on their own and wants to do it right and for the long term, perhaps. On that note, we do have to take a very quick break. Short-term stuff as well coming up on Closing Bell. Of course, we have the chat with Sushil Kedia on the technicals, and then we'll tell you about today's street chatter and the